Hi everyone, welcome to another edition of the 1040 Files. Today I have with me my good friend Alyssa Reed. Alyssa is from Dandridge, Tennessee. Where is Dandridge, Tennessee, Alyssa?
So Dandridge is in East Tennessee. It's kind of in the corner, Tennessee forms a point, and it's pretty much in the point right at the base of the mountains, foothills of the Smokies. So the mountains are there, and it's just a gorgeous spot.
Good stuff. Now isn't that where Morgan Wallen's from?
He's actually from a town like right beside of us. And I actually saw him at a stoplight the other day. So I was driving, I was like, oh my goodness, that's Morgan Wallen. So
that is so cool. That is so cool. And the other thing that Dandridge, well, I don't know if Dandridge is known for it. It has near it the largest Buc-ee's, or I think it was once the largest Buc-ee's. Alyssa doesn't know this about me, but I am a huge Buc-ee's fan. Costco #1, Buc-ee's #2 in my book. So Alyssa's with Thomson Reuters. I've taught with Alyssa on many occasions. She knows her stuff. She's a tax consultant with Thomson Reuters. And today we're going to be talking about charitable contributions. So many times clients will come to us or people will look out and they want to save money in taxes. And Alyssa, I've only come up with 3 overarching ways to save money in taxes. So the first one is one we don't like so much, and that's to lose money. If you lose money, you don't pay any taxes, right? Sometimes business owners, and I say this facetiously, what they'll do is they'll not lose money, but they'll spend money in their business, and that'll save them money in taxes. The second way that people can save money in taxes is to defer it to a future year. And so by deferring to a future year, that's typically like putting money into a 401k or a retirement plan. And again, within these 3 strategies I'm talking about, there's a whole plethora of things you can do. And that's what we're going to talk about now in this third way. And that is charitable contributions, giving money away. Tell us your thoughts on what people, if they want to give money away, how do they get the deduction? What do we do? Because again, now you look with the Tax Cuts and Jobs Act, which looks like it's going to be extended, people are doing the standard deductions, and now they might give money to a charity and not see any benefit for it. Charitable organizations are finding that their funding has decreased. So tell us, what can people do, Alyssa, to maximize this strategy to save money in taxes through charitable giving?
Well, one of my favorite, because to your point, right, when the standard deduction increased so much, people were like, well, why itemize, right? And unfortunately, why itemize also meant, well, why maybe give as much to charity? It's an unfortunate reality. But one of my favorite ways is to double up. People say, well, I still want to give, let's just pick a number, 20,000 to my church a year is what I give. And they're like, well, I don't want to necessarily give my church 40 one year and nothing the next. But they understand they need to give 40 in order to itemize.
Yeah,
so one really cool way is using the donor advised fund, which I know you're very partial to. And so we can put the 40,000 into the donor advised fund, get all 40,000 as a deduction in 1 year, and then we can slowly give the funds out over time. So our church is still getting a routine contribution that they can count on, because really charities need systematic giving, right? They can't handle ups and downs. So it's kind of a win-win with these donor advised funds.
So tell me, Alyssa, how does a donor advised fund work? What is a donor advised fund? Tell me how it works.
Can I quote you, Brian?
You can quote me.
So the donors advised fund is the poor man's foundation.
A poor man's foundation. Okay.
I love this term. You obviously use this all the time, and I stole it and I use it all the time because that's what it is, right? So when we hear about a lot of politicians, right, or very wealthy people, the Bill Gates Foundation, Jeff Bezos's foundation, wealthy people have foundations, right, that they put money into, and they kind of pay out different amounts to charities. Well, you and I can't afford to set up a foundation, right? There's all this legality. They cost a lot to administer. But with a donor advised fund, Really all it involves is going down to your financial planner, your broker, whether it's Edward Jones, Charles Schwab. You go to them and you say, I'd like to open a donor advised fund. And it's almost just like a bank account that you open with them. Very simple to set up and very cost effective way for us to give to charity.
So there are a plethora of donor advised funds out there. And like you said, I like them a lot because what you can do is you can put your money into the donor advised fund and they can invest it, and you can direct how it's invested. And then you get to choose, don't you, what charities you want that doled out to.
To your point, you get to choose the charity. But even more, I think what I hear a lot from clients is, do I only have to pick one? You don't, right? You can pick 4 or 5 if that's what you want to give to. You can pick 10 if that's what you want to give to. And I think that's a really unique feature of them.
They are. So, and you're right. And there's a plethora from out there. Fidelity has one. Schwab has one. The American Cancer Society has one. There's a lot of community foundations that have donor advised funds. And yeah, you put it in and you direct on where you want that charitable contribution to go. And so, like you said, that's a great strategy in terms of bunching deductions because, my goodness, for a married couple now, the standard deduction's pushing $30,000 and your overall taxes get limited to $10,000 of a deduction. Then you might factor in some mortgage interest. Again, maybe, you want to give money to charity, but you sit there and go, well, I don't get a deduction for it. Donor advised fund bunching deductions is a great way to do that, to maybe set aside 2 years, if possible, maybe even 3 years to put into a fund and then dole it out. So that's a great strategy that a lot of clients use. Talk to us about other strategies that clients can use in terms, because the one thing that a lot of people do is they think, well, I'm going to give to charity, I'm going to give cash, right? So they want to give cash. Is that the only thing they can give to charity? Talk to us about that.
No, I think charities are typically very accepting of anything you want to give them, right? So, I mean, simple stuff like giving, clothes to Goodwill, clean out your closets, right? All of us need to do it anyways. Let's clean out our closets. And those are non-cash items, right? So it can be something that simple. That is a tax deduction. And it can be a little bit bigger, such as giving stock, right? So let's say that I've invested in a stock that's done really well. So maybe if I were to sell it, I'd have $100,000 capital gain on it. So I pay some tax and then I say, okay, well, I sold this stock, I paid my taxes, now I'm going to give the cash to charity. I can just give the stock directly to the charity and I'm not going to pay capital gains tax. So it's a win for me. I don't pay tax. And it's a win for the charity because they're going to get more of a donation, right? They're getting the full fair value of the stock, not the fair value less the tax I paid and then the rest given to them in cash.
So that's a great strategy, especially if people have highly appreciated stock in their portfolio. Yeah, rather than sell the stock, just give the stock directly to the charity. And again, you don't have to pay the capital gains tax, and that's a wonderful idea that you can do. Talk to us about this. Many older clients, the thought of an older client itemizing for many people doesn't even cross their minds because someone who's retired might have their mortgage paid off, their property taxes, again, those get maxed. But again, if they're married, they're looking at in excess of $30,000 of a deduction. Tell us what some retirees can do, Alyssa.
This is one of my favorites, and it's called the QCD. So the Qualified Charitable Distribution. And so to your point, they're not going to have medical expenses probably, right? Because we have to clear that 7.5% threshold. And then their taxes are capped at 10. They probably paid off their mortgage. So they might be needing to give upwards of $20,000 to charity. They're not probably going to be able to do that, right? A lot of our retirees don't have that kind of cash flow. But what they can do is they've got their IRA distributions, right? Their RMDs, their required minimum distributions. And so those RMDs, by law, they have to take out, but sometimes they don't really need them. So they can have their broker send it directly to a charity. And this kind of does two things. One, it means we don't get to deduct that amount as a Schedule A charitable deduction. No harm, no foul. We weren't itemizing anyways. But what it does do is it reduces your taxable income. So you don't have to pick up your whole RMD as taxable income. So they still get a tax benefit. It's just not a charitable deduction benefit.
There you go. And that's huge because again, they can put this money aside. Maybe they're not itemizing. They can give it directly to the charity. Now that's where this one is fraught. You've got to follow some steps. And I think it's important to understand these steps. First of all, it only works for an IRA. For whatever reason, the government doesn't allow it if it's coming from a 401k plan or a 403b plan. The second thing is the taxpayer's got to be over age 70 and a half. And then the third thing, and maybe the most important, they're all important, but it's got to go directly to the charity. If I get that money, or Grandpa gets that money, cashes the check, and then gives to the charity, this thing blows up, doesn't it?
Nope, doesn't count. And you're right, that might be the biggest. You have to be contacting your broker and telling them to directly transfer it. And it doesn't have to be all of your RMD.
No.
Maybe you only want to give $3,000 to charity and you want the remaining 7,000 to come to you. It doesn't have to be at all. But like you're saying, it has to directly move from the broker to the charity. It can't come to me as a middleman and then be sent to the charity.
Yeah, that's something to be aware of. A couple other things with it. It's my understanding, Alyssa, that you can do the qualified charitable distribution, but it cannot go to a donor advised fund. That's one of the things I've learned. The other thing is that the IRS has put a maximum on it, and the maximum amount is now in excess of $100,000. I think it was $105,000 last year. I think it's a little bit more than that this year. So Alyssa, the other thing that a person can do, it's a once in a lifetime thing that a person can do with their qualified charitable distribution. Tell us about that.
So what you can actually do is take your RMD and you can transfer some of it to a charitable remainder trust, which we tend to call CRUTs. A lot of times that's a charitable remainder unitrust. There are CRATs, charitable remainder annuity trusts, but I'm going to use the term CRUT. And so what that is you transfer your RMD to this type of trust. And while the trust is in existence and you're alive, you get almost like an annuity payment out of it. So you're going to get, like a check every so often, every year. And then once you pass away, the remainder, right? That's why it's a charitable remainder trust. Anything that's remaining is going to go to a charity.
So hold on a second. I can take money out of my IRA and put it into a trust, a charitable remainder trust, and I get an amount for the rest of my life. And what's left over goes to the charity. And I get a tax deduction for that. That whole $50,000 is a tax deduction for that, even though I get some benefit from it. That's unheard of in the world of tax. Now, here's my concern about what you just said, Alyssa, and that is you have to go to an attorney, or you should go to an attorney, and you gotta set up a trust. And then you pay the attorney the documents to set up the trust. You cannot add to it, so it's a one-time thing. And then you got to pay someone like you or me to do the trust return. And I look at that and I'm going, for $53,000 of there's a fair amount of cost in there. And that's where they came up with another thing that you can do that I actually like a little bit better, and that's by doing a charitable gift annuity. And so the beauty of the charitable gift annuity is that you give the money directly to the charity. The charity has the money, they can do whatever they want, but then they pay you out an annuity for the rest of your life, and they've got the money. And when you pass away, when a person passes away, the annuity payments stop. And so I kind of like that idea just a little bit better than the charitable remainder trust. They're both great, but I kind of like that from a cost standpoint and administrative standpoint. So those are the different ways that you can give money to charities. I mean, giving money directly to charity, giving appreciated stock to charity. You can give cash to a donor advised fund. You can give appreciated stock to a donor advised fund. Heck, you can give a small business to a donor advised fund. You can give real estate to a donor advised fund. There's a whole bunch of different things in that world of donor advised funds. And then, of course, the qualified charitable distribution. So there's a lot of things, a lot of strategies people can use out there. Thank you so much for being part of today's podcast. Folks, if you enjoyed the podcast, hit the like and subscribe button. Also, would love for you to put in the comment section any topics you'd like us to discuss. So thanks, Alyssa, and everyone, go conquer your worlds.